So looking ahead into 2025, there is a very large maturity wall in Europe that could create opportunities for distressed investors like Ironshield. During the second half of 2024, we noticed the market was anticipating that. The bid for distressed paper in Europe started to become less aggressive. Bonds started to trade down into November and December of last year, resulting in wider spreads for credit, specifically with credit ratings below single B. We are now in an environment in Europe that has not existed for almost 20 years, essentially zero economic growth, but non-zero interest rates. Distressed valuations are generally, as a result, lower across the board, and as a result, post-default recovery expectations are also lower. An interesting fact for you to note is that 47% of single B to triple C rated European high yield bonds will have maturities over the next 3 years, and 20% by 2026 alone. Now, this maturity wall from 2026 to 2028 will create opportunities in 2025 because the market is forward-looking. Now, taking a step back, the European high yield market looks relatively benign given 70% of the index is double B names that have lower credit risk. But if you break out the index, you'll see that spreads, while they've compressed in the double B credit category, they've widened in the single B to triple C category where the opportunities for us are. And when you compare the single B to triple C differences between the US and Europe, there's a 400 basis point spread difference between US credits and European credits. When you think about investing in credit, what you're really doing is you're selling an out-of-the-money put option. And in a lower growth environment like you see in Europe, you don't need high growth to find interesting credit opportunities.